Hi guys, this is chapter 9 for financial accounting. We are doing long-term assets today. So long-term assets are things like equipment, PPE type stuff. So I'm going to make the video in two parts again, like we did last time, but I think these notes are only about 6 pages, so hopefully it doesn't take too long. Um, so the first thing we need to do is we need to classify our long-term assets into two categories. So our first category is called tangible assets. Tangible assets are things that you can touch. Officially, you can see or touch or kick them. So things like my desk in front of me or my chair or the building around me, things that you can touch. So these are the ones that you've always thought of as long-term assets. Sometimes we call those fixed assets. That's the same thing as like PPE type stuff because they have a fixed physical presence. Then the other category is called intangible assets. And you guys have never heard of these in this class yet. So an intangible asset is an item that you can't touch, but it is a long-term asset. So we're looking at things like patents and trademarks and copyrights and things like that. So you won't do a ton with these, but we do need to understand that these items are considered long-term assets like patents and stuff. And they're assets because they benefit us in the future. So we will write them off over time, just like we do our buildings and equipment and stuff. And we also have natural resources. And natural resources are items inside of the land, like coal or oil that you're pulling out of the land. And so these items are also assets because they'll benefit us in the future because we'll pull out the oil and then we'll sell it. And so the key thing is that tangible assets like buildings and equipment are depreciated. Okay, we depreciate them. And we've talked about that idea of depreciation back in chapter 4. Intangible assets, you amortize them. So amortize is a fancy word. And in the case of tangible versus intangible, amortizing is just writing it off over time, just like depreciation is writing it off over time. But because it's an intangible, we use the phrase amortization instead of depreciation. Also keep in mind that land is never depreciated. So land, you do not write it off. It just stays at its cost forever until you sell it. Natural resources. So natural resources are depleted out of the ground. So we deplete them, depletion. So depletion is a separate thing we do to natural resources like coal or things like that. So one of your first homework problems, I know we haven't really gotten very far and I shouldn't be talking about homework quite yet, but that's okay. So one of your first homework problems will have you looking at items and you are going to classify these items as either land, building, equipment, or intangible. And then we do depreciate, amortize, or none. So amortizing goes with intangibles. Depreciation goes with building and equipment. And none is for land. So this should be a pretty like quick 2-minute little question. So, okay, back over to our notes. So one of the things we have to figure out is every time we spend money, we can capitalize it or we can expense it. So every single transaction you run into when you're paying money, you have to figure out if you're going to record it as an asset or you're going to record it as an expense. So when we pay our employees, we usually just put it in wage expense. But if we buy equipment, we put it in an asset account called equipment. And that means that you're capitalizing it. So to capitalize something, I remember one time, Tor and I were sitting at a football game. There was a guy behind me and he was like, capitalize it. And I was like, record it as an asset and write it off over time. And Tor was like, make the first letter of the sentence big. And so we knew that when he said capitalize it, he meant, go do something with that play, like you've got a good opportunity in front of you. But when I think about capitalizing something, it means to record it as an asset and then write it off over time. So that's what we do to property, plant, equipment. And so remember, property, the land itself, you don't write that off over time, but you do for the building and equipment. So then we have to figure out like what costs get written off over time versus what costs are just expensed. So when you buy a building, the purchase price is part of the cost of the building, but also appraisal fees, title searches, realtor fees. And so all of these things are part of the cost of the building. So my key phrase that I use, so any cost to get it to you and ready for its, I think that's an apostrophe there, intended use is capitalized. So maybe writing that down might help you. So I guess it does not have an apostrophe. So things I don't know. So any cost to get it ready and get it to you, ready for its intended use, is capitalized. So if you buy a piece of equipment and you pay sales tax and delivery fees and transportation costs and installation costs, all the costs to get it ready for its intended use are part of the cost of the asset. On the other side of that, like a building, all the costs to get it ready for use. So if you remodel a building, that's part of the cost of the building. So if you buy land, all the costs involved in getting the land to you and ready for use are part of the cost of the land. So that means it would be written off like you would record it as an asset. Then you don't get to write it off over time, but it's still part of the cost of the asset. So I remember my farmers often would get sad because when they bought land for farming purposes, I would make them record it as an asset and they could not write it off on their taxes because they bought something of value, and then land isn't depreciated. So they also didn't get to write it off over time. So that was just a cost they incurred that they do not get to have a tax benefit for. And they were always annoyed with me about that. So, okay. From there, one of the things that can happen is we can have a basket purchase. A basket purchase is when we purchase a group of assets together. So like as an example, when you buy a house, there's land underneath it. So really you bought land and a house. So if you were a business and you bought a building, you buy a building, but it also comes with land underneath. So what you have to do is you have to allocate what you paid between land and building. So what's the land worth and what's the building worth? Because the land is a separate asset than the building. And so the building is depreciated, but the land is not. So it's important to allocate between the two. So to figure out how you're going to allocate between the two, what you have to do is you have to figure out an appraisal of both and then just do like a percentage of the total. And so sometimes we buy like a basket purchase that includes not just land and building, but also some equipment. So like if today I were to call up Dr. Carey and be like, what up, Dr. Carey? I want to buy BTB. And she'll say, how much? And I say, $1 million. And then she would say, okay. And I'd be like, sold. Okay. So then I would give her $1 million and I have $1 million. So I'm just going to hand it to her. Right. So I need to do a journal entry. And so my journal entry, I'm buying the building, obviously BTB, but I'm also buying the land underneath it. And then I'm buying all of the equipment. So inside of BTB, there are computers and TVs and carpets and furniture and all of those things. And I'm buying all of those things. So when I go to do a journal entry, I need to buy land, building, and equipment. So 3 debits, and then I'm going to pay cash. And I have to figure out how to take that $1 million and allocate it between my 3 different assets. It does not make sense to do 1/3, 1/3, 1/3. That's not really logical. So what we do is we do an appraisal of each item separately. And then we will take that appraised value and do a percentage of the total for each. So let's go ahead and do an example of that. So basket purchase when we're buying a group of assets. This happens to my farmers and stuff too. If they buy like a group of, or they buy like a combine, but it also came with some kind of attachment to it and they have to allocate. So, or if they buy some farm ground that also comes with 3 buildings on it, we need to allocate between those. Okay, so we're going to buy 3 assets, land, building, and equipment, and we're going to pay $500,000. After an appraisal, the fair market value of these assets. So we would have an independent appraiser come in, and when they did, they said the land was worth 200, the equipment was worth 250, and the building was worth 350. So the assets are actually worth $800,000. So we got a really good deal. Okay, so that's the first thing I want to point out. But we use the historical cost principle. And the historical cost principle says whatever you pay for the asset is what you're going to record it at. So when we do our journal entry to record this, we are going to put land, building, and equipment for a total of 500,000 because that's what we paid. And we use the monetary unit concept and the historical cost concept. And so we know that that's how we're going to record it. So when we go to record the journal entry, I'm going to come back to it, but it's the basic idea is that I bought land, I bought building, and I bought equipment. Let me put them in the right order. So it matches the given up there. So I bought land, equipment, and building, and I pay cash. So it's just like in chapter 2 when we bought building for cash, but we're buying 3 assets. And so we paid 500,000, but it looks like we paid 200,000 in cash and we got a note for the rest. So cash is 200,000, and then the loan would be for 300,000 because I paid 500,000 for all of it. And then from there, I have to figure out how much goes to land, how much goes to equipment, and how much goes to building. I cannot do 200, 250. I cannot do this. This is wrong. And 350, because that would have 800,000 in debits and 500,000 in credits. And we know we can't do that. We can't do that because debits and credits have to equal. We can't record like a gain on the sale or whatever because we didn't sell anything. So there's not a gain involved here or anything. So we have to figure out how to allocate it. So all we do is a percentage of the total. So I can see very obviously here that I think this is the only one I can do in my head. 200 of the 800 is land. So that means 25% of my purchase is land. So if 25% of my purchase is land, then I'm going to put 25% of my purchase in land. So 25% of 500 is 125, I think. So I think this number is going to be 125,000 because 25%. So the way we do it is we do the percentages. So I'm going to come up here and I'm going to build an arrow. Okay, so see how I do that? I do that a lot, right? A little caret thingy that goes to the left. It's on the comma line. Yeah. And so I'm going to say that that's 25%. And the reason why it's 25% is 200 divided by 800 is 25%. And then I'm going to say that, I don't know this percent. So if I take 250,000 of the 800, 250 divided by 800, 31.25%. Well, that's annoying because that's 250 over 800 is the equipment. And then the rest is the building. The rest is the building. So that would be 350 of the 800 goes to building. So 43.75%. 350 over 800. So what I'm going to do is I'm going to put 25% here. So 25% of 500,000. $31.25% and 43.75%. Sometimes you're like, of what? And I'm like, of our purchase. So we're going to take our 500,000 and put 25% to land, which was 125. I mentioned that earlier. And then I'm going to put 31.25% times 500,000, 156,250. And then 43.75% of 500,000 is 218,750. So if I add these 3 numbers up, they have to equal 500. So debits and credits equal. So 125, 156,250, and 218,750 equals 500,000. So that's how you do a basket purchase. The one we do in our homework is a lot easier because it's just 70-30. So they just say 70% is land. So you're going to put 70% in land. And then you'll put the other 30% in building. So it'll actually go pretty nicely. So because it says we bought a building and land for 182 in cash. And it says 70% is the land. So 0.7 times 182, and then the rest would go in building. So that's how we will do that. Okay. So let's go back over. I keep jumping into your homework because I'm kind of interested in it. Okay. So the next thing we would do is point out that after the land and building and equipment and stuff is in place and we're using it, then anything you do to fix it or whatever, it's just going to be a repair usually. So like if I buy a car and every 6 months or 3 months or whatever I'm supposed to do, I change the oil, that's just repair expense. And so every time that happens, we're just going to put it in repair expense. But if I have to overhaul the engine and I spend, $3,000 doing some big engine repair, then that's considered an extraordinary repair because it might extend the life of the asset. And so at that point, I might actually capitalize that. And so I might record engine overhaul as an asset and then write that off over 5 years or something. Because if it's going to last longer than a year and it extended the life of the asset, then it's going to be capitalized. Okay, so the whole rest of this chapter is really going to deal with depreciation expense. So depreciation expense is when we record that an asset is being used up over time. And so we do depreciation for our building and equipment. We do not depreciate land. We do not depreciate land because land doesn't get used up over time. So we've covered depreciation before. We covered it in chapter 4. And so now we're going to calculate what the depreciation is. So back in chapter 4, I would just tell you depreciation is 20,000, record it. And you would just do depreciation expense and accumulated, and you would do the journal entry. But now you're going to find the dollar amount that's depreciated. So to figure out how much depreciation we're going to record, we need 3 things. Well, first we need to know what system we're using, like what method we're using. And I'm going to teach you guys 3 different depreciation methods. So I'm going to teach you straight line, which is the one that everybody uses for the most part for regular purposes. So straight line, and then units of production and double declining balance. And so I'm going to teach you 3 different depreciation methods. Straight line is the most commonly used, but double declining balance, we use a version of that for tax purposes. And so it's very common too. So the things we need to know to be able to do depreciation, 3 things. We need to know the cost of the asset, its salvage value, which is its value at the end of its useful life. And then we need to know how many years or whatever it's going to last. So some type of estimate of the number of years that the asset's going to last. So we need the cost, the useful life, which is how many years or usage it's going to last, and then the residual value or the salvage value, which is its value at the end of its useful life. This is a very important formula. We're going to do it lots of times, but the book value is defined as cost minus total depreciation taken to date. When you see that word right there, total depreciation taken to date, remember that's accumulated depreciation. Okay, so that's what that's called. Total depreciation taken to date is accumulated depreciation. Okay, so that's that. I don't know why I worded it like that, but total depreciation taken to date is an accumulation of all of the depreciation. So when we do our journal entry, we will debit depreciation expense and we will credit accumulated. We did that back in chapter 4. Because remember, as we used up supplies, we would move it to supplies expense. But as we used up an asset, we moved it to depreciation expense. And then to credit, the other side of that is the contra asset called accumulated depreciation. So I'm going to teach you the first 2 methods first, and then I'm probably going to pause my video and do the other method as a separate one. So the 2 different methods I want to teach you first are straight line and units of production. So straight line is the most common method that we use. And here's that formula again. So you guys need to want to like highlight this or something to make sure you notice that this formula book value is cost minus accumulated. Okay, set it up here also, cost minus accumulated. So the straight line method, we're just going to divide it over the same, it's going to be the same each year because it's just going to be an amount divided by like 4 years or 5 years or 39 years. And so all assets have a useful life in years somehow given. So equipment normally lasts 7 years. Vehicles, they usually write those off over 5 years. Buildings are 39 years. And so it used to be 39 and a half, and they wanted to simplify it. So they moved it to 39, which makes no sense. Like for tax purposes, we could just use 40. That would be significantly easier, but whatever. So cows are 5-year assets. Fence is a 7-year asset. So all assets have a different useful life. I'll always give it to you, but you can look it up for tax purposes by just searching for it. There's a depreciation guide that we use as accountants. It's a little booklet that gets printed, but I just Google it and look for what the IRS guidelines are. So, okay, so here's the formula for straight line depreciation. We take cost minus residual divided by years. Now we did this at the beginning of our chapter 4 notes when we were enterprise rent-a-car, but we only had one car. And we said that we were going to drive a car and we bought the car for $24,000. And at the end of 4 years, it was going to be worth, so at the end of 4 years, it was going to be worth $4,000. So we did 24 minus 4, and we said it was 20,000 over 4 years, which was 5,000 each year. So we actually did that back in chapter 4. Units of production, the formula is exactly the same on top. It's cost minus residual. And residual and salvage mean the same thing. So salvage value and residual value just mean the value at the end of its useful life. And so in the straight line method, we divide by years, but on units of production, we divide by some kind of usage, like number of miles on a car, number of hours on a machine, number of copies on a copy machine. So some unit of usage. And it's going to give you an amount per mile or an amount per hour or an amount per copy. And that's how we depreciate. So we'll see this on the next page. So let's get through this page and then we will take our break in between our video. So Luciano's Pizza buys a car to deliver pizzas. Okay. The cost of the car is $14,000. And then it's going to be used for 5 years. And after that, its residual value will be $2,000. So we're going to buy it for 14. And at the end of its useful life, it's going to be worth 2. Okay. Now, when the asset is all used up, it's called it's fully depreciated. Okay. But the asset still exists. It's still an asset. It's just basically used up. So it might not have a value anymore. Okay. But at the end of its useful life, it's going to be worth 2. In those 5 years, we think we're going to drive that car 80,000 miles. And then at the end of the 5 years, we're ready to sell it for 2,000. So the first thing we want to do is we want to calculate depreciation using the straight line method. So the straight line method is cost minus accumulated, and then we're going to divide by 5 years. So cost, not minus accumulated, I'm sorry, cost minus residual. So 14 minus 2 divided by 5 years. So 12,000 over 5 years. And so 12,000 over 5 years, if we divide that, then we get 2,400 each year. So 14 minus 2 is 12. 12 divided by 5 is 2,400 each year. So every single year, our depreciation will be $2,400. It's not going to vary between different years. Every year is 2,400. The only time it varies is in the very first year. You might only get a partial year because if you buy it on October 1, then you only own it from October to December. So you only own it for 3/12. And so then you'd get a portion of it. And then in the last year, you would get the remaining 9 months. So then you would depreciate it a little bit differently, but we're not going to do that in this class. We'll do that a ton in other accounting classes, but this one, I'm just teaching you the basic idea. So in my pretend world, we run out on January 1 and we buy all of our assets. Okay. That's weird. It's not really how it works. So, okay. So then in the units of production method, instead of dividing by, so the top part of the formula is going to be exactly identical, but instead of dividing by 5 years, we're going to divide by some unit of usage. So in this case, they said that our vehicle is going to be driven 80,000 miles. So 80,000 miles means that every single time we drive the vehicle, we will depreciate it for a mile. So what we'll do first is we will get an amount per mile. So we're going to take 14 minus 2, which is 12. And instead of dividing by 5 years, we're going to divide by 80,000 miles. And we get an answer of 15 cents per mile. Because if you take 12,000 and you divide by 80,000, you get 0.15. And when students do that, they assume they've done something wrong. It's like, I got a really weird answer. It's really little. And it's supposed to be, okay? Because every time you drive the car 1 mile, it's going to depreciate 15 cents. And then we're going to go back in and we're going to be like, okay, in year 1, 10,000 miles. 10,000 miles at 15 cents a mile. So every time we drive a car, it's 15 cents. Every time we drive a mile, it's 15 cents times 10,000 means the depreciation for year 1 is going to be 1,500. Now, remember up in the other method, it was 2,400 every year. So it didn't vary. It was just 2,400 in year 1, 2,400 in year 2, 2,400 in year 3. But with this method, we have to keep track of how many miles we drive every single year. And so a lot of people don't use this method because they don't want to keep track. But it is not that hard to write down the odometer reading at the end of each year and just be like, okay, last year it was this much, now it's this much. So it isn't that big a deal. But people don't usually use this method. This method's actually kind of legit because it really keeps track of how you actually use the asset. Because if you don't drive the car, then you're not really depreciating it much. So it keeps that in mind. So I kind of like this method. I think it makes sense. But if you had, 500 cars in your list of assets, you wouldn't want to keep track of all of them necessarily. So that's why people don't do it. So in year 1, you're going to take 15 cents times 10,000 miles. And I really showed my work when I did this. And so you don't have to write out all of this. But I said year 1, 10,000 miles, 15 cents a mile, 1,500. And then you can do that for each of the years. So the next year it would be 15,000 miles. So 15,000 at 15 cents. Is 2250. Year 3, we drove 20,000 miles, and so that would be 3,000. Oh, sorry, year 3 was 18,000. So year 4 will be 3,000. And then in year 5, we drove 17,000. Now, again, in my pretend world, I drove exactly 80,000 miles in 5 years, and then I stopped depreciating. But what can really happen here is you could drive, 40,000 miles in the first year, and then you take a whole bunch of depreciation in the first year. And then maybe the next year, you only drive at 5,000 miles. And then maybe the next year, you drive at another 40. Well, that means you actually used up the asset in 3 years. So if that happens, then you stop depreciating. So you just stop depreciating whenever you hit 80,000 miles. So it could happen in 5 years and it could take 10 years, but you just keep depreciating the asset until it hits 80,000 miles. So in the 5th year, we did 17,000 miles at 15 cents a mile. I'm sorry, these are all kind of screwy. I want to fix it. Oh, okay. Fine. Looks a little better. Okay, so let's add up our total depreciation. You don't really have to, but in total, we should have depreciated it basically 12,000, because here we depreciated it 12,000 because we did 2,400 each year. It's 5 years, we did 24 or 12,000 total. And here we did 1,500 and 2,250 and 2,700 and 3,000 and 2,550. So we still depreciated it the 12,000. And so it's just basically trying to figure out whatever. It's just figuring out the timing of it. So the timing of when you record the depreciation is different in our different methods. And so here we did the same amount each year, but here the amounts varied. Sometimes it was more and sometimes it was less, but overall you still write off a $12,000 amount over the life of the asset. So to practice the journal entries, that you need to know the journal entry for year 3 with the second method. So I want to do a journal entry for that one. And the journal entries would be dated 12/31 because it's you depreciate at the end of each year. And we would do depreciation expense and accumulated. depreciation. And year 3 of the second method is 2,700. And you would do that entry every year. And so with the straight line method, it would be 2,400 and it would be the same every year. With the units of production, the first year would be for 1,500, then 2,250, 2,700, 3,000, and 2,550. So, and then the next question says, what is the book value of the equipment at the end of year 3? Okay, so practicing book value. Book value is cost minus accumulated. So the cost of the asset is 14,000. And then the accumulated, it says book value of the equipment at the end of year 3. So we're looking at the second method. And so what I would do is I would put like a little bracket around these, but I can't do that while I'm in this program. So I would just make them the yellow so I can see all 3 of those. So the accumulated depreciation is an accumulation of the depreciation that's taken so far. At the end of year 3, accumulated would be 1,500, 2,250, and 2,700, 6,450. So 14,000 minus 6,450 is 7,550. Okay, so that's the book value. So remember, the formula for book value is cost minus accumulated. If you want to write that down. Okay, what if we sold this asset for 8,000 at the beginning of year 4? Okay, so my book value, my books say the asset is worth 7,550. I am selling it for more. I am selling it for more. I'm selling it for 8,000. So that's going to be called a gain on the sale. So this is the fanciest entry in this chapter for sure, and maybe one of the fancier entries we cover in the whole class. So what we do when we calculate gains and losses, when we sell an asset, is we compare the selling price versus the book value. Okay, so when we do that, we're looking at selling price of 8,000 versus 7,550. So I'm running out of room here, yeah. So what we would say here is that we are selling it at a gain because we sold it for more than the book said it was worth. So that would be gain. Okay, so that's a gain. But let's say that you couldn't remember that. You're just like, I don't know what happened. I sold the asset. Okay. So what the journal entry looks like for this, and the journal entry is a little bit complicated, but I want you to keep in mind like what the purpose is. The asset left the building. Okay. So we're selling the asset. The asset goes away. So when we sell the asset and the asset goes away, it's this vehicle, right? This car of Luciano's Pizza, and it's gone. And so we did not wait until it was fully depreciated. We did not depreciate it all the way down. But let's go ahead and do what we know as far as the journal entry goes. We brought in cash of 8,000. We always know what to do with cash. Cash is my favorite account. We always know that if you receive cash, you debit it. But I'm going to skip some lines and go to the very bottom line. The equipment leaves the building. So the van, vehicle, whatever, delivery car is leaving the building. And when students are trying to figure out the dollar amount to use, I want you to keep in mind that when you bought the equipment, when you bought the vehicle, it was for 14,000 and you put it in equipment. Since then, all you've done is depreciated over time, but the depreciation entry does not involve equipment. So equipment is still sitting there at $14,000. And the equipment's leaving, so I'm going to remove it because the equipment's gone. But when the equipment leaves, so does the accumulated, because we were depreciating the asset, but we're not going to depreciate it anymore because it's gone. So we need to eliminate accumulated. So accumulated is a contra asset, and so it has a credit balance. So when we get rid of it, we need to debit accumulated. So when we get rid of it, we need to debit accumulated. So accumulated is sitting there, and it's at the beginning of year 4. So we have depreciated 1,500 and 2,250 and 2,700, the 6,450. That's the balance right now in accumulated, and it needs to go away because the asset is gone. When the asset leaves, so does its accumulated. So I need to debit accumulated for 6,450. And if we look at our debits and credits right now, I have 8,000 and 6,450, which is 14,450. And then I only have a credit of 14. So my difference is a credit of $450 so that my debits and credits equal. And so that $450 is because we sold it for more than the book value. The book value was 14 minus 6,450. The book value was 7,550. So the difference here is this $450 gain. So we can call it gain on sale of equipment. You can just call it gain. It's fine. Gains are like revenue because gains are good, right? So gains are like revenue, and revenue is a credit, so is gain. If the difference would have been a debit, then it would be a loss. So if the cash would have only been 7, then we would only have 13,450, and then we would need a debit instead. And the debit's name would be loss because debits are like expenses. Okay, losses are like expenses. So I could have figured out the gain by saying 8,000 versus 7,550 or whatever, but I can also just do the journal entry. And if it's a debit, it's a loss. And if it's a credit, it's a gain. So this is a good stopping place. When we come back, we'll do double declining balance, and then we'll do a nice big practice one. Okay.